Retiring with over $1 million in savings is an ambitious goal that can seem out of reach for many people earning $50,000 a year or less. However, accumulating such a sizable nest egg is achievable through diligent saving and strategic long-term investing. While it requires diligence and sacrifice, it is possible to retire with 7 figures or more in the bank, even on a modest salary if you start early and stick to a sound financial plan. Retirement savers on a $50,000 salary or less can stay on track to have $1 million or significantly more stashed away by the time they leave the workforce for good. Ready to learn how? Let's get started. Calculating your savings goal. One of the first steps in setting a retirement savings target is to estimate how much you'll need annually to fund your expenses once you stop working. As a general rule of thumb, most financial experts advise having 25 to 30 times your expected annual retirement income saved. Using this standard guideline, if you anticipate needing $30,000 to $40,000 per year in retirement, that equates to a target savings amount between $750,000 and $1.2 million. It's also a good idea to plan higher than this base guideline to account for rising healthcare costs as you age, as well as general inflation over the long span of a retirement that may last 20 to 30 years or more. With diligent contributions starting in your 20s or 30s, $1 million may be a conservative goal rather than just an ambitious dream. Maximizing contributions. Once you've calculated your savings goal, the next step is maximizing what you can contribute each year. Aim to put 10 to 15% of your pre-tax income towards your employer-sponsored 401k, especially if they offer matching contributions. Employee matches effectively double a portion of your savings for free, so be sure to contribute at least up to the match level annually. In addition, maximize your Roth IRA contribution of $6,000 per year, or $7,000 if over age 50, for the opportunity of tax-free growth and qualified withdrawals in retirement. If your income exceeds Roth eligibility limits, consider setting up a backdoor Roth to still benefit from this tax-advantaged account. Leverage other triple tax advantage savings vehicles too, like contributing to a health savings account, a HSA, if enrolled in a high-deductible health plan. HSAs offer pre-tax contributions, tax-free growth, and withdrawals for medical expenses, even in retirement. Once you've hit the maximums allowed in retirement and health accounts, direct the remaining savings above your matched 401k amount into a low-cost, index-based brokerage account. Look for ways to increase contributions by taking on a side job or reducing unnecessary expenses through lifestyle adjustments over time. The more you can contribute each year, the faster your savings will add up towards your goal. The power of time. One of the most powerful tools in your favor is simply having time on your side. The sooner you start contributing to retirement savings each month, the more your money has time to grow through the magic of compound interest. Just $100 invested monthly at a 7% average annual return will grow to over $370,000 if you start at age 22, but only around $195,000 if you wait until age 32. That's over $175,000 in potential gains just from getting a 10-year head start. Charts and calculators that visualize this can really drive home the impact of starting earlier. For example, you'd likely hit that $1 million goal we talked about with monthly contributions of about $300 if starting in your early 20s. But wait until your 30s, and you'd probably need to save closer to $500 monthly. Doesn't that extra 10 years make a big difference? The lesson is clear. Don't delay getting retirement savings on autopilot as early as you can. Invest wisely. Now that you've got savings building in your retirement accounts each month, how do you want those contributions to actually grow over the long haul? The simplest approach is choosing low-cost, diversified funds that track the entire stock or bond market. Index funds offer great returns over time at a fraction of the cost of managed mutual funds. More money stays invested instead of lining the pockets of fund managers. As the past several decades clearly show, the best thing you can do is continue contributing regularly, regardless of whether the market is up or down at any given moment. Resist the urge to panic and pull out of the market after a dip. Over the years and decades, stocks tend to trend up overall. Staying invested means your dollars buy more shares when prices are low. Cut costs. Increase income. While increasing your contributions over time is important, the other side of the coin is decreasing your expenses to help boost your savings rate. Do you currently have any high-interest debt like credit cards that could be refinanced to lower rates? Looking for ways to consolidate payments and save a little each month adds up. You may also be able to reduce housing costs by downsizing, getting roommates, or moving somewhere more affordable. Carefully tracking your spending can uncover unnecessary outflows to target for trimming without impacting your lifestyle. In addition to cutting back, considering taking on extra work in your spare time is a smart strategy. Side gigs, freelance work, or starting a small business on the side have the potential to significantly boost your bottom line over the long haul without dramatically impacting your work-life balance. Even a few extra $100 monthly makes a difference. For larger income gains, assessing your career and marketable skills is wise. Additional education, certifications, or training open doors for higher pay. With affordability in mind, focus on opportunities with expedited completion and clear salary increase potential. The goal is to save more each year without feeling like you're depriving yourself today. Combining income increases and spending reductions is an effective 1-2 punch. Ride out bear markets. While stock market declines can feel nerve-wracking, history proves these downturns are always temporary. Charting past crashes like 2000 and 2008 shows recoveries and new highs following within years. Resist the impulse to panic sell low. Instead, keep regularly contributing throughout volatile periods. Your dollars will buy more shares at bargain prices. If you don't expect to use the money for 5+ years, a cash reserve ensures you can avoid tapping retirement funds during a pullback. Staying invested smooths out the ups and downs over the long haul. Regular rebalancing, readjusting annual check-ins keep you on target. Rebalance annually to maintain your original risk levels as allocated totals shift over time. Also, reassess contribution percentages to maximize savings incentives. As retirement age approaches, you may want to slowly shift to less volatile bonds. If life changes reduce savings ability, consider working longer if possible. Finally, claiming Social Security benefits fits your strategy. Monitoring after retiring helps adjust your withdrawal rate as needed over 20+ years. I hope you found this breakdown of how to retire with over $1 million in savings on a $50,000 salary informative. With diligent long-term planning, it is very achievable. Be sure to like, comment, and subscribe for more retirement planning advice. Thanks for watching. Start putting these tips to work so you can feel confident in your financial future. See you in the next video.